Hello, Jason Bates here, owner of Electrum Financial, located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. If you like the lowest rates at the lowest cost, then allow me to put my 30 years experience to work for you. You've got nothing to lose. Here is this week's mortgage market at a glance. Global financial markets are interconnected in many ways. Even though something that happens in the UK will have more of an effect on UK markets, if the effect is big enough, it's felt around the world. Last week's rate spike was most readily attributed to market panic over a budgetary decision in the UK. The drama of the past 2 weeks has been more than big enough. The UK and US bond markets are more correlated than most. Here's an updated chart showing the relative movement in each country's 10-year sovereign debt. Now keep in mind, higher yields equal higher rates. This was a very serious episode for global financial markets and especially for the UK. Markets expected some sort of official intervention on Tuesday. When it didn't come, rates experienced their sharpest spike. Then on Wednesday, the Bank of England stepped in to soothe the markets with an emergency bond buying announcement. This is essentially the UK's version of quantitative easing. While that didn't undo all the damage that had been done, it had at least stemmed the tide of rising rates. Here's a different visualization of the US and UK 10-year bonds, this time with separate y-axes, simply to show the correlation in movement. It's not clear whether we've seen the last of fiscal policy fallout from the UK, but the Bank of England's emergency announcement means that the next response won't likely be as volatile. As dramatic of an episode as this may have been, it wasn't all about the UK. Most central banks are generally enacting policies that push rates higher in the name of fighting inflation. The UK news wouldn't have hit as hard if rates weren't already up so much around the world and if markets weren't already on edge about inflation and the associated policy responses. The Fed is a frontrunner in rate hiking policy. This refers not only to hiking the actual Fed funds rate, but also to decreasing the amount of bonds on the Fed's balance sheet, something that puts additional upward pressure on longer-term rates like mortgages. When that rate backdrop combined with the UK induced volatility this week, it caused big issues for mortgage rates in the US. The average 30-year fixed rate topped 7% on Tuesday. Many lenders were still able to quote rates in the sixes, but that required some upfront costs. Normally, a mortgage borrower can opt for a higher rate in exchange for lower upfront costs or even a lender credit. This is referred to as premium pricing because investors typically pay a premium for a higher rate of return. That premium can then be used to cover upfront loan costs. Premium pricing has been non-existent at times in 2022, and the well ran almost completely dry over the past 2 weeks. There are a few reasons for the absence of premium. The simplest is that lenders don't want to rely on earning higher interest over time to make their profits if risks are higher than that borrowers will refinance at the first sign of lower rates. The complicated reason is complex enough to avoid discussing it in detail, but it has to do with the speed of the shift in financial markets and the fact that the mortgage-backed securities required to facilitate premium pricing simply don't exist in quantities required to create a healthy, liquid market. That absence of investor participation in the realm of premium pricing means that lenders can actually offer you much better terms if you pay points. Here's the most striking example of the absence of premium pricing. Now, for many lenders this week, they would make more money by giving you a loan at 6.625% versus 7.625%. Say what? They absolutely do. And indeed, some lenders with their own cash to lend are happy to offer the higher rate. Other lenders have to consider what investors are actually paying to acquire those loans, those higher rate loans. And in many cases, this past week, it was about the same for a 6.625% or 7.625% loan. On a mortgage-specific note, if market volatility decreases and rates manage to stay flat, premium pricing will gradually return. And in fact, this was already happening in several noticeable ways by the end of last week. As for rates in general, what's next depends on inflation and the economy. The Fed is afraid of shifting to a less unfriendly stance too quickly due to lessons from the past. It has concluded that it would rather make the mistake of hurting the economy too much as opposed to the mistake of not doing enough to fight inflation. Because of this stance, economic data is key. Strong data will only embolden the Fed's position and put more upward pressure on rates. On the flip side, weak economic data, seen in multiple reports for a few successive months, will get the Fed's attention. In fact, this is their goal. They want to see economic pain because they believe it will help inflation fall back in line with its target range. Now think about that for a moment. They want to see the American people in financial pain for something that I believe they caused. #insane. Now, assuming that pain translates to lower inflation, the Fed will pause to reconsider its policies, but this will take several months at a bare minimum. And if we take the Fed at their word, it would be more than a year before they would consider cutting rates. In the meantime, cues can come in bits and pieces, especially from more important economic reports. This week has several of those with the ISM and PMIs on Monday and Wednesday. Then on Friday, we'll get the next installment of the all-important jobs report, one of the only economic reports capable of challenging the consumer price index in terms of market movement potential. The jobs report is the report to watch in my opinion. If the jobs report starts to trend higher, then the Fed will have to pull back on its aggressive approach to the Fed funds rate. Now, the CPI is released on October 14th. In the meantime, the housing market is suffering. As long as that suffering is measured and not overly disruptive to the financial market, the Fed actually prefers it. Again, #insane. Now, whether or not changes have been measured is debatable. Certainly, if I use the apex of the recent housing and mortgage boom as a baseline, the reversal has been extremely abrupt. This is even in the case of home prices, which normally lag further behind rate hike cycles. In new numbers for July, released this week, both of the big home price indices recorded the highest and biggest month-over-month declines since the Great Financial Crisis. If I step back a bit and view the data in annual terms, it does indeed look more measured. The catch is that the annual appreciation will certainly continue to drop in this rate environment. I can't be sure how far it will decline, as it will somewhat depend on supply and the jobs outlook, both of which will be regional. It's important to understand that the powder keg of the ingredients responsible for our current predicament is vastly different than 2008's example. In other words, in 2008, the housing and mortgage markets caused the downturn, a fact that both markets and consumers were slow to forget in the following years. In the present case, the housing and mortgage markets are in infinitely better position to emerge strong from the economic downturn the Fed is determined to deliver. And so there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I'd like to be your broker of choice. Until next time, take care and stay safe.